Hey, Facebook friends, Chevy Ortiz here, your bilingual loan officer with the Ortiz Group at Thrive Mortgage. I wanted to share with you here a question that I keep getting asked and running into, and what is the difference really between a consumer credit report and a residential mortgage credit report, and why the consumer credit report may only have two credit scores or maybe just one, versus a residential mortgage credit report will have all three credit scores. So I wanted to take a minute to give you guys some insight and information. So first and foremost, there's a huge difference between the credit risk analysis on a consumer credit report versus a tri-merge or residential credit report. That's why in a consumer credit report, you get two scores, and on a tri-merge credit report, you get three scores. Now, the three bureaus that were all looked at as a residential mortgage credit report is Equifax, which usually will have on a residential mortgage credit report a Beacon score of 5.0. You would also have Experian, which is the other one, is Fair Asset, usually a Beacon score credit model of V2. And you will also have TransUnion, which is more known as FICO, and that usually have a credit model of, say, Classic 4. Now, there are big factors that actually combine your credit, and they all look at it completely different. And so what is mainly looked at, for one of them, for example, is your payment history. Your payment history has a big factor as to what that is going to show now, but also what has been shown in the past, whether it's good or bad. Whether you kept your payments on time or you had collections or judgments or accounts or charge-off, it really plays a big role. Matter of fact, payment history accounts for 35% of the actual credit scores model. The second one is amount owed. How much do you owe on whether it's a revolving account or an installment account? How much is owed also plays a big factor. That's actually 30% of your total credit modeling systems as well. It is highly recommended to keep your balances below 30% of the actual credit limit. And that's either whether it's an installment account or a revolving account as well. Installment accounts, for example, a car loan, student loans, personal loans, and then you've got the revolving accounts, which is your secured cards or credit cards are, as well. Then also the other model that we look at is the length of credit history. The length of credit history actually accounts for 15% of your total credit models as well. Length of history, the longer you have that account, whether it be a student loan, a car, or a credit card, the longer you have that account, the better. Of course, in good standing, with good payments on time, the better it is for you. That history, usually after 3 years, it looks really good. After 5 years, it looks even better on your total credit report of outstanding or great or not miss a payment on those accounts. The fourth item actually that accounts for also your credit scores is a credit mix. A credit mix is simply having some accounts that are installment accounts and then some accounts that are actually revolving accounts. So it's a combination of both, and that actually makes up about 10% of your credit models as well. And then the last item is new credit. New credit also accounts for 10% of your total credit model. So if you're opening a new credit card or if you have a new car or a new loan, that counts about 10% of your total credit model. So as you can see, it's okay to go get new credit, particularly if you're just coming out of college or you're just building up your credit. That's okay. Just know that it's going to take a little bit of time before the scores shoot up. Of course, keeping your balances below 30% of the limit and having a great mix between installment accounts or revolving accounts, and of course having a little bit of the account mix and the history behind it as well. So I hope this helps. Yes, and there are three different credit scores that we look at when we're looking into a residential mortgage. You've got three different from the Equifax, TransUnion, and Experience, and we go by the middle of the credit scores whenever we do a credit risk analysis and find out what type of loan or mortgage loans we can actually help you out with. So I'll give you an example. So if we've got a credit score of 700 with the Experian, and you've got another credit score, let's just say 600 with TransUnion, but you've got a 650 with Equifax. Well, that 650, which is basically the middle score, is a credit score that we go with to give you your credit analysis and help you with your home loan. I hope this helped. Thank you again. This is Shervy Ortiz, your bilingual loan officer with the Ortiz Group at Thrive Mortgage. Have a great day.